Good evening, class. Good evening, Manshika. Yes, good evening, Mansha. Yes. So, what did we do in the last class? Yes. In the last class, we discussed about the section 40, section 40A disallowances, right? And then we discussed about section 43B. We'll quickly recap. What was section 40? Section 40 had certain disallowances. The number one disallowance was in respect of the 40A1A, which is TDS. TDS, if not deducted on the expenditure or deducted but not paid, then in case of the expenditure which is paid to a non-resident or outside India, in that particular case, there will be the disallowance. There will be the disallowance under section 40A1A. But when the disallowance will happen, there's a CBDT circular which says that the disallowance will only happen when the sum is chargeable to tax. The sum is chargeable to tax. So FTS, royalty, interest, or any other sum chargeable to tax. So even when I'm paying any interest, FTS, but that is not chargeable to tax, then in that case, there will not be any requirement to deduct the TDS. And if there is no requirement to deduct the TDS, there is no question in that case of disallowance, right? Under 40A1A, right? So the disallowance will only happen when the sum is chargeable to tax, right? Then next one we did is 40A1A, which is in respect of the payment to a resident. Payment to a resident. In that case, there is disallowance. If the TDS is not deducted or TDS is deducted but not paid, then in that particular case, the disallowance will be the 30% of the expenditure. Now, under both 40A1 and 40A1A, the expenditure will be allowed in the year in which TDS is deducted and paid. Okay, the expenditure will be allowed in the year in which the TDS is deducted and paid. Now, in case the payee has furnished a return, included this into the income, paid the taxes due thereon, then in that particular case, the payer will not be considered as assessee in default. There will not be any disallowance, but there will be the interest at the rate of how much percentage of interest? Yes, the interest will be there at the rate of 1% per month in case when the payer has, even though the payee has made the included the income in his return, paid the taxes, but still there will be the interest at the rate of 1% on the TDS deductible from the date on which it was to be deducted till the date of furnishing the ROI by the payee. Otherwise, what is the interest? In case the TDS is not deducted, the interest is 1% per month. From the date of deduction till the date, from the date it was to be deductible till the date it is deducted. And 1.5% if the TDS is not paid from the date it was deducted till the date it was paid. But in the case where the payee has included it into return of income, the income, and paid the taxes, furnished the CA certificate, then the interest will be only 1%. But there will not be any disallowance, right? Then 48(1)(b), which was the equalization levy. If the payer fails to deduct or fails to deposit the equalization levy, then 100% disallowance. It will be allowed in the previous year in which the equalization levy is deducted or paid. Here, there is nothing like that the payee should have included in the return of income. That exception is not there for equalization levy. 48(3) was salaries payable outside India or to a non-resident, in which case there is neither the TDS deducted nor the TDS has been paid. Then in that case, there is 100% disallowance. There is no exception unlike 40A1 or 40A1A, that if the payee includes it in the return of income, that particular income, the disallowance will not be made. That exception is not there for the salaries paid to a non-resident. Also, this is a permanent disallowance, meaning the expenditure will not be allowed in the next previous year, even if the TDS on that salary has been paid and deposited. 48(1)(4) was in respect of payment, which is made from the PF the withdrawals which are made from the PF, on that the TDS should have been deducted. If there is no TDS deducted, the amount will get disallowed. Then 40A5 is tax paid on the perquisite on behalf of employee. Since that it is exempt in the hands of the employee, it is not considered as a taxable perquisite. It will also be disallowed in the hands of the employer. 40B was remuneration and interest paid to the partners of the partnership firm. In that case, what are the conditions for the remuneration? Payment should be to a working partner. It should be authorized and in accordance with the partnership deed. It should relate to the period after the partnership deed. What are the limits? On first 3 lakh, or in case of loss, 1,50,000, higher of 1,50,000, or 90% of book profit. On the balance book profit, it is 60%. What is book profit? The net profit as computed as per the provisions of the Act. Okay. Then if the amount is disallowed under 40B, it will also not be taxable in the hands of partner under 28(5). Interest, again, it should be paid in accordance with the partnership deed and should be relating to the period after the partnership deed. What is the limit? 12% per annum. Then if the payment is made to a partner who is acting in a representative capacity, but the interest is on loan which is borrowed from him, then in that case, it will not be covered by 40B. It will only be in respect of the interest or interest which is paid to a representative partner on the capital of the firm to which he is representing, right? So in that case, only there will be the interest, or there will be the disallowance in the 40B. Or let's say, for example, if the payment is being made to a partner in respect of the loan borrowed by third person, then in that particular case, again, that will not be covered by 40B. Then 40BA, which is in respect of interest or remuneration to the members of AOP or BOI, that is again disallowed. There are no limits to that. Again, the same representative capacity thing will be applicable in terms of the AOP BOI, same in the same way as it is applicable to a partnership firm. Then 48(2) was the payment to a related party over the fair market value. Expenditure to any related party over the fair market value will get disallowed. Over the fair market value portion will get disallowed and not the entire expenditure. Be careful about it. So here, what will you do? Let's say, for example, if I am making the payment of expenditure, let's say to the director of a company, or let's say to any concern in which I have the substantial interest, then let's say the expenditure which is paid to that particular concern, over and above the fair market value, let's say the fair market value is 10,000, expenditures of 20,000, so 10,000 will get disallowed. 48(3) is in respect of the cash disallowances. So expenditure in cash over and above 10,000, for transport operator it is 35,000, will get disallowed. Okay. Even the opening balance which is there, so the past expenditure which has been claimed, now it is paid in the current year in cash over and above 10,000, will be disallowed as the will be considered as the income, deemed income of the current year. The expenditure of the past previous year paid in cash in the current previous year, then it will be considered as deemed income. There are exceptions under Rule 6DD. What are the exceptions? Payment to SBI, LIC, government, agri-produce, cottage industry, or in any village or town, gratuity terminal benefit to the employees less than 50,000 on retirement, salary to employee posted for greater than equal to 15 days at any place or shift and where he does not maintain any bank account. Then in that particular case, there will be the, even if the cash payment is more than 10,000, expenditure will be allowed. Provision for gratuity disallowed under 40A7. Contribution to unrecognized provident fund, 40A9 disallowance. And then we had section 43B, which is deduction on the payment basis. So what does it covers? Tax, duty, employer contribution to PF. Employee contribution to PF is not covered under 43B. Remember 36(1)(5)(a)? Here you can write down explicitly employee contribution to PF not covered by section 43B. Bonus or commission, interest on loan or borrowing, leave encashment allowance, right? Now, interest on loan also, conversion of loan interest into loan is not equal to actual payment. Only when you pay that loan, you will get deduction. Deduction is allowed under section 43B only on the payment basis. If the payment is made before the due date of filing return of income. There is new inclusion, sum paid to MSME beyond the time limit specified in section 15 of MSME Act. Now, what is section 15 of MSME Act? If there is an agreement, the time period as per agreement, or maximum 45 days, whichever is earlier. If there is no agreement, within 15 days. So if you have not made the payment within the period under section 15, then only you will go to 43B. So your payment will be allowed only when you actually make the payment before the due date of filing return of income. Otherwise, if you're covered under section 15, it will be allowed on the accrual basis. The expenditure will be allowed on the accrual basis. So this is what we did, right? Then we did 33AB. So 33AB is the amount tea, coffee, rubber development account, right? So if you are into the business of growing and manufacturing of tea, coffee, what is the quantum of deduction? Amount deposited in specified account, you have to deposit 6 months from the end of the previous year or before the due date of filing return of income, whichever is earlier, 40% of the PGBP, lower of that, you will get the deduction. So how will the deduction be computed? PGBP minus deduction, total income. That will be as per rule 8 or 7A. That will be divided into taxable and exempt because this is a composite income. For tea, it is 40/60. Rubber, it is 35/65. Coffee, it is 25/75 and 40/60. Then what are the conditions? The conditions are the books of accounts should be audited. What if we withdraw the amount? Amount cannot be withdrawn except as specified in the scheme. It is allowable only in case of closure, dissolution, liquidation, death, or partition. In case of closure and dissolution, there will be deemed income on the closure or dissolution. If you withdraw for ineligible assets like plant and machinery in the office premises, office appliances, or plant and machinery used for manufacturing, that will be deemed to be the PGBP. If the amount remains unutilized, again, that will be income. If the amount is used for paying business expense, that will not be allowed. If the asset acquired in accordance with the scheme is sold off within the 8-year period, then the cost which was allowed as deduction will be deemed to be the income. So, exception is the transfer to the government or succession of firm by the company. Then 33ABA is site restoration fund, which is again similar here, except that you will get the deduction lower of amount deposited or 20% of PGBP. Yes, students, are you thorough with it? Vanshika, there seems to be problem at your end in terms of voice. I think the voice is audible to everybody else. Yes, students? No, Mansha, there is no specific method for calculating 20% of profits. Whatever profits you compute as per PGBP, on that 20% is allowed. Good evening, Viraj. Good evening, Sailesh. Good evening, Mohammed. Good evening, Shankara, Ravish. Yes, good evening. Okay, so let's proceed further. Next is section 35. Scientific research. Scientific research expenses, section 35. Now, in scientific research expenses under section 35, what is allowed? So earlier, there used to be different limits for the allowability. But so far as now it is concerned, now everything is allowed at the rate of 100%. So in case of scientific research, everything is allowed at 100%. But what do we need to keep in mind is that what exactly is allowed under section 35. So let's write it down. We'll make a small chart over here. What is allowed under section 35. You can write down expenditure on scientific research. Yes. So expenditure on scientific research, you can start drawing the chart. Yes. So the first expenditure which is allowed under section 35 is in respect of own business, and second we will divide it into paid to others. So we are going to divide into two segments for own business and then paid to others. Now in respect of own business, whatever expenditure, the capital as well as revenue. Again, we will divide it into two segments, the pre-commencement and post-commencement. Pre-commencement and post-commencement. So, pre-commencement will include the revenue and capital expenditure. Again, the post-commencement will be including both the revenue as well as capital expenditure. Now, capital expenditure prior to the commencement of the business. Capital expenditure prior to the commencement of the business and the revenue expenditure prior to the commencement of business is allowed as deduction. But how many years prior? 3 years prior. You can write down the capital expenditure and the revenue expenditure for the 3 years prior. Okay. So, pre-commencement expenditure of 3 prior years. Okay. 3 prior years. I will divide it into capital expenditure, revenue expenditure. Now, what is capital expenditure covering? The capital expenditure covers any expenditure which is of capital nature, which is incurred prior to the commencement of the business within the 3 years preceding the commencement of the business. Now, it includes all the capital expenditure except land. Capex except land. So, except land, every capital expenditure which is incurred prior to the 3 years will be allowed as deduction at the rate of 100%. Okay. So, 100% of the expenditure is allowed. Even in case of the revenue expenditure, what revenue expenditure it could be? It could be on the purchase of material inputs. It could be the salaries which are paid. Now, this will be also allowed as deduction at the rate of the 100%. Now, revenue expenditure also of the 3 years prior to the commencement of the business. So, salary plus purchase of material. Now, this will be allowed in the year, deduction in the previous year in which business is commenced. So, you will get the deduction in the previous year in which the business is commenced. This is section 35(11). Revenue expenditure is section 35(11). Okay. And for the capital expenditure, it is 35(11)(a). Okay. Section 35(11)(a). Fine. Yes or no? Okay. So this is the capital and the revenue expenditure, which is prior to the commencement of the business. Now, what about the expenditure which is post commencement? Again, the capital as well as revenue expenditure, both is allowed. Both is being allowed. Okay. So, you can write down capital and revenue, which is post the commencement of the business. Now, once the business has been commenced, that particular expenditure we are talking about. Okay. So, in that particular case also, whatever expenditure is being incurred, again, that is allowed if it relates to the business of the assessee. The scientific research relates to the business of the assessee. Again, the capital expenditure should be other than land. Okay. Other than land. Again, this is 100% allowed. So if the scientific research is in relation to its own business, then the revenue and the capital expenditure will be allowed to you in the year in which it is incurred. For the 3 years prior, it's the year in which the business is being commenced. Now, once you claim the deduction under 35, no depreciation will be allowed on any capital asset which is purchased. Are we getting that? So no deduction will be allowed on any capital asset which is being purchased in terms of the depreciation. Because you are claiming the deduction under 35, you cannot claim the depreciation. Now, in case if the capital expenditure which is there cannot be, or if the profits are not sufficient to absorb the capital expenditure. Let's say I have 100 rupees profit. My capital expenditure on scientific research is let's say 150. So there will be unabsorbed capital expenditure that will be treated like the unabsorbed depreciation. Means it will be allowed to be carried forward and set off against any other head of income in the coming years. So indefinitely you can carry forward and set off. So unabsorbed capital expenditure treated like unabsorbed depreciation, carry forward and set off against any head other than salary or indefinite income. Fine. Okay. Now what if the capital asset which is purchased, which is claimed as deduction under 35, and now that asset is being sold. If I have purchased the capital asset and sold that capital asset which is used for the scientific research, if it is sold, then there will be deemed income under section 41. So capital asset used for scientific research, if it is sold, and is sold, then what will be the consequence? Then the proceeds of the sale proceeds, sale consideration plus deduction claimed under section 35 1(4). 35(1)(4) is this post commencement, section 35(1)(4). Fine. So the capital expenditure, the sale proceeds together with the amount of deduction made under section 35(1)(4), if it exceeds the amount of the capital expenditure, total capital expenditure, the cost of the asset basically, then the excess will be charged to the year in which the sale takes place. So let's say if the capital expenditure incurred is 3 lakh, deduction would have been, let's say, of 3 lakh. Now, if the asset is sold for 4 lakh rupees, then what will happen is, then in that particular case, if the asset sold is of 4 lakh, right, and the deduction was claimed of rupees 3 lakh. So here the deduction which is claimed by me earlier. So what will happen? 4 lakh is my sale consideration. 3 lakh is the deduction I have claimed. Total expenditure was of 3 lakh. So the difference which is there of 3 lakh taxable under section 41(3). Are we getting that? So taxable under 41(3) is the amount which is claimed as deduction earlier, or let's say if the deduction earlier would have been, let's say, 2 lakh instead of 3 lakhs, then in this particular case, what we would have taken as the income here? We would have taken the income only rupees 2 lakhs. because that's what the deduction you have claimed earlier. So you have to take basically the excess amount or the deduction made, whichever is less. So if the deduction is 2 lakh, the excess amount would have been, let's say, how much in this case? Let's say if the deduction claimed earlier was 2 lakh, then it would have been 5 lakh. The excess was 5 lakh. So here you will claim the 2 lakh rupees. So basically, lower of taxable under 41(3) is lower of the deduction claimed earlier or the excess amount. Okay. Okay. Fine. Now, what will happen is, let's say I would have, let's say I would have sold the asset. Let's say I would have sold the asset for rupees 4 lakh. The 3 lakh is going to be taxed under 41. What about that 1 lakh? 4 lakh minus 3 lakh. What will happen to that? That will be taxable under capital gain. Are we getting that? So the 3 lakh which you have claimed as deduction earlier, that is being charged to tax under 41(3). But there will also be capital gain. There will also be capital gain of rupees 1 lakh, which is 4 lakh minus 3 lakh. Okay. So this similar thing, like, if you remember, we had done balancing charge under 41(2) for the power generating units, right? It's the same thing over here. So if you have claimed the deduction, up to that deduction amount, that will be treated as the income under 41(3). Are we clear? And the balance will be capital gain. Now, the amount which is paid to the others. Okay, one more thing before we move further. If the asset is capital asset is not sold, but capital asset used for scientific research is transferred to the other business. What will be my actual cost? Yes, you have to give me the answer. This we have already done. Yes. What will be my actual cost? If I'm selling the asset, then what will happen? The deduction allowed earlier is being reversed now under 41(3). And there will be additionally capital gain also, which is the difference between the cost of the asset, the amount taxed under 41(3) and the sale consideration, right? But then, what will be the scenario when I'm using the asset for other business and I'm not selling it off? What will be my cost for the purpose of depreciation? It will go to the block of asset because now you are not using it for scientific research. You will transfer it to the block of asset of other business. So what will be my cost of acquisition? Actual cost for the purpose of depreciation. Yes. Faster, students. Yes, what will be the actual cost? We have done that. Go back to your notes. What was actual cost? Yes. No, Geeta. No, Mansha, that's not correct. We have done that in the depreciation class. If you do not remember, let me go back to the depreciation chapter. See, you have to keep revising these things, otherwise you will forget. Asset purchased for which deduction claimed under section 3514, which is scientific research for capex. What is the cost of acquisition? Nil. So if the asset is purchased on which deduction is claimed already, then the actual cost will be nil because the deduction has already been claimed under 3514. Now, if you're transferring to another business, the actual cost will be nil. So you can write it over here. Actual cost is nil. Section 43(1). Yes, student. Is it clear? Vanshika, the question was, what would be the actual cost in case the asset is not sold but transferred to my another business, which was used earlier for scientific research? The actual cost will be nil. Did you get it, all of you? If the asset is sold, then you will have the income taxable under 41, which is what? Under 41, the income taxable is the deduction claimed earlier, right? And in case the amount is there now, if the asset is not sold but transferred to other business, then in that particular case, the actual cost will be there for the purpose of claiming depreciation. But since we have already claimed deduction under 3514, the actual cost will be nil. Yes or no? Are we getting this particular point? Yes. Yes, yes, yes. Fine. Okay. Now understand one more thing. Deduction under 35 will be available or will not be available for 115BA, B115BAA, 115BAD, BAE, BAC. Which particular sections I told you at that time would be available to the assessee under 35? Remember the concessional tax regime class, the basic concepts. I told you there are certain deductions under scientific research which will still be available. Yes, under 115 BAC. Which were those? Let me take you there. But before I take you, you should give me the answer for that. Yes. Which were the deduction? The scientific research expenses relating to the business by one own self, including the expenditure prior to the commencement of the business, and the capital expenditure which is except for land. So, under 115 BAC, BAD, BAA, BAE, all of those concessional regime that we have studied so far, the expenditure should not have been claimed for the scientific research in order to get that particular concessional tax rate. But still, as I told you, it does not cover all the scientific expenses. So, which ones are the left out? So, it covers 35. It covers there 35. 1, 2, which is the 35, 1, 2 is in respect of what? 35, 1, 2 is in respect of the revenue expenditure, which is post commencement. 35, 1, 2A and 35, 1, 3. These expenditures they cover. Other than that, they do not cover it. So 3511, which is there, which is the expenditure, which is revenue expenditure. prior to the business. So 3511, you can write it over here. Yeah. So you can write while claiming, or just write it like this. Let's write in the table itself so that it will be easier for you to remember. Allowed for concessional tax regime. So 3511 is allowed in the concessional tax regime. Are you getting that? Which is the revenue expenditure. Then, as I said, 351A, 351 is in respect of the revenue expenditure. In respect of the capital expenditure, whether that is also being allowed? Yes. So 3511 is the revenue expenditure, which includes the pre-commencement expenditure as well. 3514, which is there, is a capital expenditure. 3514 is the capital expenditure. Now, in respect of the capital expenditure, which is prior to the commencement of the business, commencement of the business, whether that will also be allowed? Yes. Read the provision over here and tell me whether that will be allowed. Yes. So 3511 is allowed, which includes both the capital as well as the revenue expenditure. This is also 3511. So this is also allowed for concessional tax regime. And the pre-commencement expenditure, which is a capital expenditure in nature, that is under 352(1)(a). It should not be 3511(a), it should be 352(1). Now, if you go back, sorry, this is 3521(a). If you go back to the basic concept class, what did I tell you over here? Capital expenditure is also allowed, including the one, so there is no restriction if you look at it in terms of under section 115BAC for the prior commencement capital expenditure as well. So meaning the capital as well as the revenue expenditure will be allowed. Are we getting that? Yes. So both of them will get allowed. Okay. So just write down. So you can write it over here. This is also allowed for the, or let me just write it here only. Sorry. Allowed for the concessional tax regime, and even this is allowed for the concessional tax regime. Okay. So for the concessional tax regime, you will get the revenue as well as the capital, pre as well as the post commencement being allowed. Fine. So just write down here also. In case of claiming concessional tax regime, capex plus revenue, pre plus post commencement, allowed. So what is not allowed under 35 is the rest of the expenditure which are paid to others. So if it is for own business, this will be allowed even when you are claiming the concessional expenditure, a concessional tax rate. Okay. No Geeta in-house research expenses, in fact, not available. Fine. Now, with what is the paid to others? So in terms of paid to others, if it is paid to an Indian company for scientific research, paid to Indian company for scientific research, for the scientific research. Secondly, if it is paid to the university, institution, college for statistical research, paid to university, college or university or college or institution for the statistical research. Fine. And the last one is paid to the national laboratories. Paid to the national laboratory. Okay. Or third one also, sorry, there will be one more. Paid to university, college or institution for scientific research. And last one is paid to the national laboratory. Paid to the national laboratory. Fine. So all of these are allowed to the extent of 100% of expense. But you have to remember here the section number because it can come in the examination just like scientific research under 35 2AA. So it may come just like that. So 35 2AA section is for the payment to the national laboratory. In case of the expenditure which is paid to a university, college or other institution for statistical research, then it is under 35.13. This is under 35.13. Fine. Then in case the expenditure is paid to an Indian company for scientific research whose object is to do scientific research, that is under 35.12A. 35.12A. And for the scientific research paid to any institute or university, this is under 35.12. Now, understand here these expenditure not allowable as deduction under section, while claiming the concessional tax rate. While claiming concessional tax rates. Okay. Also, one more thing in case of scientific research expenses. So, this 35 deductions which are there, right? These would be available only when you opt out under 115BAC, right? Or even in the case of the 115BAA, these 35 deductions will be available only when you go as per the normal provisions. If you are going as per the concessional, these will not be available. Only the capex and revenue expenditure is going to be available. Are we clear? Also, these associations need to obtain the approval from the government. Wherever you are contributing, they should be approved university or research association. So basically now they have a requirement to prepare a statement also from where they are getting these particular donations. And they also need to furnish to the donor that this is what the donation they have received for scientific research. Without that, the donor will not get the deduction and it will be considered as income of the donee also. So the deduction which is given under 35(1), 2A, 3, 2, all of these or 2AA would not be allowed unless the company which is receiving these contribution is a registered company with the central government and it has delivered a statement to the government of the donation received. It has also given a statement to the donor that this is the donation that we have received from you. Are we clear? Yes, yes or no? Fine. Okay. So this is their scientific research expenses. Next deduction is section 35 AD. Section 35 AD. Investment based deduction. After this, we are going to start the questions. Okay, solving the question. There will be one more deduction which will be left out, for which I'll explain and then we will take the question. Or let's do one thing. Let's start solving the question only. This I'll take it up later because otherwise you may not get an opportunity to solve the questions. Okay, so this also we will take it along with the question itself. So let's start. I have put a question on 33AB. Okay, here. You can copy it from the screen. I'll just change the period over here. I think there's a mistake. This should be. You can start copying the question. Meanwhile, I'm making the changes. Yeah. Start solving the question. Start copying also. Start solving also. Now you will get a real idea whether you have understood PGBP properly or not. I will make the screen enlarged. Yeah. You have only 5 minutes to go through the question. Have you copied the question so that we can start solving together as well? Yes, students, have you copied? Okay, let's start solving then. Meantime, others can copy. So label T is engaged in growing and manufacturing of tea. Net profit is 50 lakh. Company was incorporated on 1st June 2021. Following were debited and credited to the P&L. Depreciation is rupees 5 lakhs. So what will happen in this case? Depreciation is rupees 5 lakh. What will you do? Yes. Here you can write down also. Let me make an amendment where I have written depreciation on computers is 80K. Here you can write down one adjustment. The company utilized the amount for purchase of office equipment rupees 1 lakh and computers rupees 2 lakh. Depreciation on computers as per ICAI is 80,000. You can put it like that. Okay. Yes. What will happen to the depreciation of rupees 5 lakh? Add back depreciation. Yes, Viraj. So we will add back the depreciation. Okay. So just let's start jotting down. My net profit is as per P&L account is how much? 50 lakhs. Fine. Add items disallowed. So first is depreciation as per books of accounts. How much is it? 5 lakh. Okay, depreciation as per books of account. Next is charges of rupees 1,30,000 paid by an account paying check for advertisement in souvenir published by the political party. Yes. What will you do in this case? Yes, students. What will happen in this case? Yes, students. Faster. Viraj, okay. Yes, Geeta, you are correct. Yes, others also, please start contributing. Yes, students. So, what will happen in this case? Yes, so 1,30,000 which is there, sorry, 1,30,000 which is there will get disallowed. So this I will disallow. Okay. This will be disallowed under which section? contribution for advertisement to political party souvenir disallowed under section 37. Yes, disallowed under section 37. What was the subsection? Students, you have to start remembering. You cannot just write disallowance. You have to write with the specific section number. You are CA final students. So this is disallowed under section 37 2B. Section 37 2B. Okay. So 37 2B. Specific disallowance is there. How much is the amount? 1,30,000. Yes, will this be the only effect? Will this be the only effect for this? What do you think? Whether this will be the only effect? Yes. Whether there will be any disallowance, any other implication on this? Expenditure for the political party which is incurred, which is disallowed under section 37 2B, but the same will be allowed as the deduction under 80GGB. So you can write it over here when I will do chapter 6A deductions. Then contribution to the political party under section 80GGB. What is the amount? 1.3 lakh. Fine. So this is by an account pay check. If it would have been by cash, then no deduction under section 80GGB. Okay. Fine. The company incurred the preliminary expense of rupees 42 lakhs. The company incurred the preliminary expense of 42 lakhs. Yes. Allowed, disallowed. Yes, students, faster. Please be fast. Okay, it will not be allowed. This is going to be disallowed. Yes, so disallowed, Mansha. Yes, correct. Geeta, there is no information given for the 1/5 allowed as deduction. This is the preliminary expenditure which is incurred prior to the commencement of the business. So therefore, in that particular case, we have no information regarding the 1/5 to be claimed under 35D. We will just disallow it. Now, in case, let me just modify the question little bit over here. Let's say, for example, if I give certain additional information to you. Let's say the additional information that I give it to you is that the company has cost of project of 400 lakhs. Let's write down. Let's say cost of project is, let's say, 400 lakhs. Okay, cost of project is 400 lakhs and the capital employed is 700 lakhs. Capital employed is 700 lakhs. Fine. Now, what will be the deduction which will be eligible over here? So for this, we will go to section 35D. Now I'm discussing here, that's why I put this point over here. See, preliminary expenditure are generally not allowed. What did I say? Profit and gains arising from the business or profession carried on during the previous year. So any prior period expense, any future expense is not allowed. The only exception is the recognized provisions as per ICDS 9, which are ascertained and which are capable of being, which are certain and which are capable of being ascertained. Other than that, the future expenses will not be allowed. The preliminary expenses also will be allowed in accordance with section 35D. Other than that, they will not be allowed. So only express provision where it has been made, only in that case it will be allowed. Or for example, if you look at 35, prior expenses are allowed. That is a specific allowance has been made. So for preliminary expense, if no other information would have been given, we would have just disallowed. Now section 35D, what does it say? Now section 35D is a specific provision for the preliminary expenses. Now section 35D, what does it say? It provides for amortization of preliminary expense. It provides for amortization of the preliminary expenses which are incurred by either Indian companies or any other non-corporate taxpayers for the establishment or expansion of the business. So, preliminary amortization of preliminary expense for the expansion or establishment of business. Establishment or expansion of the business. Okay. Now this is applicable to the Indian companies, to also the non-corporate assessee. For the new companies, it means the expenditure incurred prior to the commencement of business. For the existing company, it means the expansion expenses which are there till the new unit is being commencing the production or operation. For creating new expansion or creating the new business line, so any expenditure in relation to that. Now, what is the eligible expense over here? What are the eligible expenses? Now, the expenses in connection with the expenses which are in connection with the, let's say, preparation of feasibility report, preparation of the market report, conducting some survey which is there. So all of these expenditure which are there, these are the expenses which are allowed. These are the expenses which are being considered over here. So eligible expense could be market survey, feasibility report, right? Or engineering services, whatever expenditure are there. But the assessee has to furnish a statement containing the particulars of the expenditure before 1 month from the due date of return, so that the government gets to know, or the income tax department gets to know, what are the expenditure. Or let's say the MOA, AOA charges, legal fees which are there, any expenditure for subscription of the shares or debentures, all of these expenditure. So issue of shares, drafting of MOA, AOA, legal fees. These are my eligible expenditure. Fine. Now what is allowed? Deduction allowed is 1/5 of expense. Deduction allowed is 1/5 of expense. Now, what is the overall limit? There are limits to the allowability. So, in case of the Indian company, we will divide it into two segments. If it's an Indian company and others. Now, for the Indian companies, 5% of the cost of project, 5% of the cost of project or 5% of capital employed, whichever is higher. For the others, it is 5% of the cost of project. Now, whatever amount will come, out of that, 1/5 will be allowed. So, of this amount, you will allow 1/5 over 5 years. Are we getting that? What do we understand by the cost of project? The actual cost of the project, which will include the fixed assets, land, building, whatever machinery is there. So all that cost which is incurred to bring the business into existence. Are you getting that? So that is my cost of project. What is capital employed? The capital employed means, you can write down, the capital employed means the share capital plus debentures plus the long-term borrowings. Share capital, debentures, long-term borrowings. This is the meaning of my capital employed. Okay. Now, there is always one question. There's a one specific question over here which arises. Whether the amount of securities premium will also be considered while calculating the capital employed. Let's say, for example, if I would have given you here in the question, capital employed is 700 lakhs. Let's say it includes, you can write it like this, it includes security premium of rupees 100 lakhs. Now, whether the capital employed is to be considered along with the security premium or without the security premium. Yes. So, the Supreme Court, in the case of Berger Paints, right now, Supreme Court in Berger Paints held that security premium is not capital employed. Why? Because this is not part of the capital employed. Security premium is not part of the capital employed. This specifically says share capital. So share premium is not part of the share capital. And therefore, the security premium will not be considered over here. So, what is the capital employed? Share capital, debentures, and the long-term borrowings. That's very, very, very specific. Now, last point under 35D is that in case there is amalgamation and demerger within the period of 5 years, so you get a 5 years window, right, to claim this amortization. Then the amalgamated company or the resulting company can claim this deduction. So you can write down here, in case of amalgamation or demerger, amalgamated company can claim the deduction. Fine. Now in this particular scenario, what will we do? The expenditure is 42 lakh. What is the cost of project and what is the capital employed? So first we will disallow this 42 lakh for sure. Preliminary expense disallowed 42 lakh. You can write it over here. Less items allowable. Preliminary expense as per section 35D. 1/5 of. So this working you can show it in your notes also behind your answer. I'm showing it over here only. 1/5 of 5% of the cost of project or 5% of capital employed. This is a company, right? Higher of this. Now what is 5% of my cost of project? 5% of 400 lakhs or 5% of 700 minus 100 lakhs. So you will write into the notes as per Supreme Court ruling in Berger Paints Limited. Security premium is not part of the share capital and therefore it has to be reduced. Not capital employed. Okay, you will write. I'm not writing in detail, but you have to write it in the examination. Fine. So what amount comes here? Yes. So if you take over here 5% of 400 lakhs, 20 lakhs or 5% of 600 lakhs, 30 lakh. What is higher? 30 lakh. So 1/5 of 30 lakh. So 6 lakh is what will be allowed to me. Yes, students, is this very clear? Yes. All of you clear about 35D? Mansha, we have to disallow depreciation because it is as per books of accounts. All of you clear about this? Yes. Okay. Let's move further then. Profit from sale of, the company utilized the amount for purchase of office equipment rupees 1 lakh and computers rupees 2 lakh. Depreciation on computers as per Income Tax Act is 80,000. Yes. The company utilized the amount from the specified account. You can write it like this. From specified account. Yes, what will be the implication of this? Yes, students, what will be the implication of this? Office equipment not allowed. Yes, Viraj. So we have to add back. What about computers? It is allowed. So you have to add back office equipment. You don't have to add it back. You have to consider this as a deemed income. So add that is not disallowed. That is deemed income. Office equipment purchased. Office equipment purchased, which is ineligible withdrawal under section 33AB. What is the amount which is there? The amount is 1 lakh. Computers are allowable. right? Computer is allowed. Yes, Mansha. Geeta, amount utilized from specified account only in respect of the office equipment is not the eligible asset. So only that will be considered as deemed income. You will not disallow it. You will consider it as deemed income. This is not an expenditure which has been claimed. You can only disallow the expenditure which has been claimed as deduction. This is not claimed as deduction. This is withdrawal from the specified account. So this will be your deemed income. This is not disallowance. Use the words appropriately in examination. Otherwise, you'll lose out marks. Have we claimed this as deduction? Answer is no. We may have claimed this deduction in the past year. So this is the deemed income of the current year. You will write a note in the examination. This is an ineligible asset and this will be deemed to be the income in the year in which it is withdrawn. Are we clear? So this will be deemed income. The computer is the eligible asset for which you can withdraw the amount from specified accounts. So that will not be deemed to be the income. What about the depreciation on the computers? Now you have claimed the deduction of the asset, right? You have claimed the deduction when you have taken the amount, when you have deposited the amount in specified account. Now, whether you can also claim the depreciation on that asset, the answer is no. You cannot claim the depreciation because once you have already claimed the entire amount as deduction, now you cannot claim any depreciation. So, depreciation will be added back. Depreciation on computer, 80,000. Fine. Next is profit from sale of green tea leaves, rupees 20 lakhs. Profit from sale of green tea leaves, 20 lakhs. All the students, please be participative. This is very important class. You have understood the concepts, but if you are not able to solve the question, you will not be able to write in examination. This is the opportunity for you. Even though you may go wrong, that is better if you go wrong over here. You can write your mistakes in the red highlighter in the red pen with the highlighter that this is the mistake you are making in this question at the moment, so that you do not repeat this mistake. But if you will not participate, how will you know your mistake? Mansha, no, this will not be bifurcated into 40-60. Yes. All the students, be participative. Please be participative. Vanshika, no, this will not be bifurcated into 40-60. So, if an income is of composite nature, then you bifurcate into 40-60. This is the entirely agriculture income. Yes, Geeta, correct. So this will be 100% exempt. So only when you are into, let's say, growing and manufacturing, if you are in a composite income, if you are having the composite income, only then you can claim the 40-60 rule that is applicable to a composite income and not to the solely agricultural income. This will be exempt under section 10(2). Are we getting that? So this you will claim it as an exempt income under section 10(2). This is exempt under section 10(2). So you will reduce your less profit from sale of green tea leaves exempt under section 10(2) as agri income. Fine. What is the amount? 20 lakhs. Okay. Last one, replacement of the parts of plant and machinery amounting to rupees 15 lakh, for which sum of rupees 30 lakhs was withdrawn from the deposit account maintained with the NABARD. 10 lakhs remain unutilized. Yes, you can change your little bit. Let's make it 25 lakhs. This 30 lakh will not give you the correct answer. Sum of rupees 25 lakh. What will you do in this scenario? Mansha, yes, the assessee is engaged in growing. You're correct. But here, what is the income he has received? He has income to receive from sale of green tea leaves. That is simpliciter and agriculture income. If he would have grown the green tea leaves and has manufactured the tea from that and he derived the income from selling of tea, then you will apply Rule 7. But in case he has only stole that green tea leaves directly, that is simpliciter and agriculture income. And that will be exempt under 10. Yes, Viraj, you are correct. What about the amount spent for repairs? Yes, Vanshika, correct. Yes, 10 lakh disallowed. No, Geeta. So in this particular case, first the amount which is withdrawn from the NABARD, that is for the replacement of the plant and machinery. Now, if I have withdrawn the amount which is for the replacement of the plant and machinery, I can consider this as a revenue expenditure, but I will not allow this expenditure. Here I am not claimed as deduction. If it is given in the question that replacement of plant and machinery is particularly my deduction which is claimed over here, right? If it is a deduction which is claimed over here, then in that particular case, I will disallow it. Here, what does the question say? Following were debited and credited to P&L. So, which means that yes, the deduction has been claimed. If the question does not say anything whether the deduction has been claimed, if let's say instead of point number 5, this would have been forming part of the other information, then I would have not allowed the deduction of repairs and maintenance. If it is revenue expense, we will assume that this is revenue expense. Then we would have not allowed this as an expense because you have already claimed the deduction when you have deposited the amount in the special account. Now, once you withdraw that amount and use it for the business expense, you will not get any deduction. Are we clear? But here, since you have already claimed that deduction, so we will disallow 15 lakh rupees. So, replacement of plant and machinery, repair expense, not allowed under section 33AB. So, you will disallow 15 lakh. Okay. Let's say, for example, if I am giving you the fifth adjustment over here in other information, amount withdrawn from special account for salaries of employees, rupees 3 lakh. So now this will not be allowed as deduction under section 33AB. because revenue expenditure from the withdrawal of the amount is not allowed. Yes, and balance 10 lakh which has remained unutilized. This is not disallowance, this is deemed income, Geeta. This is not disallowance, this is not an expenditure, this is the deemed income. So again I will consider over here unutilized amount 10 lakh is my deemed income. Yes, fine. Other information, this we already considered. Cost of project 400 lakhs and capital employed share premium, this we have already considered. The company has acquired the plant and machinery at rupees 40 lakh, building at rupees 25 lakh and furniture at rupees 10 lakh. The company has obtained the bank loan of up to 50% of the plant and machinery, which was then waived off by bank. Furniture of rupees 5 lakh was purchased in cash. Yes. So what will do? What will be your depreciation, students? Let's calculate depreciation on assets. First is plant and machinery, and second is furniture, third is building, right? So what is the value of those assets? 40, 25 and 10 lakh. Actual cost 40, 25 and 10 lakhs. Yes, first for the plant and machinery, what about the waiver? What about the waiver? Yes, students. Yes, Geeta, that's correct for furniture, but what about plant and machinery, the amount which has been waived? Here it is written that the company obtained bank loan of up to 50% of the cost of plant and machinery, which was then waived off by bank. What will happen to that? So the amount which has been waived off by the bank. If you remember, what is the meaning of the actual cost under 43(1)? Actual cost means the actual cost of asset to the assessee as reduced by the portion that has been met directly or indirectly by any authority. So if you remember, I told you the waiver of bank loan will get reduced. If you remember this, what was the actual cost? See, cost met directly or indirectly by any other person or authority. So if the waiver of the bank loan is there, if it is for the business, then 28.4. If it is for capital asset, reduce from the capital asset. So we will reduce it over here. Okay. So we'll reduce it over here. So just reduce it from the cost of asset. Give me a moment. Okay. So reduce the waiver of bank loan as cost met indirectly by any other authority. Section 43(1). Okay. So 20 lakh. Fine. So my actual cost will be 20 lakh. Fine. For the furniture, asset purchased in cash greater than rupees 10,000. So that will be not allowed. If you remember, this also we have done it over here. Sorry. So if you remember this, what did we do? The asset purchased in cash greater than rupees 10,000 is to be reduced, right? So we will reduce it over here. I think there's some problem with this screen. Okay, yeah. How much is the value of the furniture purchased in cash? It is furniture purchase is 5 lakh. So 5 lakh. This will give me furniture of 20 lakh. This is 10 lakh. Now what will be the depreciation rate on this? On plant and machinery, what is the depreciation rate? It is 15%, right? This is 10%. This is 10%. Plus there will be additional depreciation, which all of you have forgotten. 20%. Why? Because the company is in growing and manufacturing of tea, isn't it? So the company is in growing and manufacturing of tea, and therefore you will also allow the additional depreciation. Clear? So what will be my total depreciation over here? 20 lakh into 15%. 3 lakh is the depreciation. Here 2 lakh and 1 lakh. So this is equal to 6 lakh. Plus additional depreciation is how much? 4 lakh. Right? So this is 4 lakh. So you will write it over here. Less items allowable. Depreciation as per Income Tax Act, which is 6 lakh. Additional depreciation under section 32(1)(2)(a). This is 32(1)(2). This is 4 lakh. Fine. Now, brought forward business loss is 1 lakh and amount deposited in NABARD is 6 lakh. So calculate the PGBP and the deduction for me. Yes. Calculate the PGBP and the consequent deduction for me. Yes, students, faster. And then you can take a break of 5 minutes. So I'm taking a break over here, but you have to calculate and give me the answers after the break. Okay, let's take a break of 5 minutes and mean. Okay, so what are the answers coming, students? Yes. What is the answer coming to? So what we will do is, let's start evaluating your answers. 50 lakh plus 5 lakh plus 1.3 lakh plus 42 plus 80,000 plus 15 lakh. This gives you 193.3. Just verify it. Minus 6 lakh, minus 20 lakh, minus 6 lakh again, minus 4 lakh. This is 36 lakh minus. So 193.3 lakh. This is giving me 157.3. And then in that, I am adding 11 lakhs. So this is giving me 168.3, right? Now, what about brought forward losses? I will not first reduce the brought forward losses. So we have to take into consideration the PGBP without the brought forward losses. Now, here if you look at it, what are the percentages which are given under 33AB? So under 33AB, for the growing and manufacturing of tea, it is 40 and 60%. So 60% is exempt, 40% is taxable. But before that, we will calculate the 33AB deduction. So now what will be my 33AB deduction? The 33AB deduction is the amount deposited. This is my PGBP. Deduction under section 33AB is lower of amount deposited in special account, or what is the amount? So under 33AB, the deduction is 40% of PGBP, right? So here I will take into consideration the 40% of 168.3. Now what is the amount deposited in special account? It is 6 lakh. So this is 6 lakh versus this is 40% of this is 67.32 lakh. Lower of this is going to be 6 lakh. So 168.3 minus 6 lakh will give me 162.3, which is my PGBP, right? From this, I will reduce. From this, I will reduce the brought forward business loss, right? First, to reduce the brought forward business loss. So what is my brought forward business loss? It is 1 lakh. So my PGBP is 161.3 and minus 1.3 lakh. So my total income will come to 160 lakh. Sorry. I think I made one mistake over here. Sorry. This is not the taxable PGBP. We have to now find out the taxable PGBP first. Sorry, before setting off the brought forward business loss, I will have to find out the taxable PGBP. I'm so sorry over here. So PGBP, out of this, exempt PGBP as per rule 8. So 162.3 into 60% is going to be exempt, right? 97.38. So taxable PGBP will be 64.92 minus brought forward business loss of 1 lakh. So this will give me 63.92, and my total income will be 1.3, 62.62 lakh. Is this clear? Yes, student. Is this clear? Viraj, it's not going to be 86 lakh. Yes. So this is what your answer is going to be. Fine. Okay. Okay. So let's proceed further. Then we move on to the next deduction, which is 35 AD. Now, before we move on to the question, let's discuss about 35 AD. So section 35 AD is section 35 AD. Investment based deduction. Now here you get the deduction of capex as well as the revenue expenditure. This is investment linked deduction. So 100% of capital expenditure, which is wholly and exclusively for the specified business, will be allowed to you as deduction. So 100% of capex, which is wholly and exclusively for specified business, is going to be allowed as the deduction over here. Fine. So that is 35 AD. 100% of the capital expenditure is allowed to you. Now understand one thing. In terms of the 35 AD, there are certain restrictions and conditions. Now, what is the capital expenditure? Which kind of expenditure is allowed and which kind of businesses are being covered over here? So there are list of businesses. So I'm just showing you from your module itself. Let me just show you from the module that what are the list of businesses. See, setting up and operating cold chain facilities, setting up and operating warehousing facilities for agricultural produce, laying and operating a cross-country natural gas or petroleum oil or crude or pipeline network, building and operating a hotel of 2-star category or above, building and operating a hospital anywhere in India, building and developing a housing project, production of fertilizer, setting up and operating inland container depot or container freight station, beekeeping, setting up operating a warehouse facility for storage of sugar, operating a slurry pipeline for iron ore transportation, operating a semiconductor water fabrication manufacturing unit, developing or operating and maintaining a new infrastructure facility. So 100% of the capital expenditure incurred would be allowed as deduction under 35 AD. Now, what is the expenditure which is not allowed? Except land, goodwill, or financial instrument. That is not allowed as deduction. Also, cash expenditure greater than rupees 10,000, greater than rupees 10,000 is not allowed. Fine. Now, when you claim the concessional tax regime, deduction under 35 AD is not available. Now, here you will also be allowed the expenditure prior to the commencement of the business, which will be capitalized in the books of accounts on the date of commencement of the business. So that will be allowed to you as the deduction in the year in which the business is commenced. So you can write down expenditure prior to the commencement of business if capitalized in the books of accounts as on the date of commencement. Allowed in the previous year in which business is commenced. Fine. Next is, what are the conditions? As I said, this is investment-based deduction, so there are certain conditions. Business should not be formed by splitting or reconstruction of existing business, should not be formed with or should not be set up using old plant and machinery. So if you look at it, these are the same conditions what we have under 115 DAB for claiming the concessional regime for the manufacturing entities, and under 115 BAE for manufacturing cooperative societies. Again, here the exception will also remain the same. Value of second-hand plant and machinery is less than 20% of total value of plant and machinery, or it is imported second-hand plant and machinery. So these are the similar conditions what you have there as well, right? So these are the conditions for claiming the deduction under 35 AD. Are we clear? Yes. Now the losses from the specified business, in case there is a loss. So the loss which is there can be only claimed against the profits from the specified business. Section 73A. So losses from specified business can be claimed against profit from specified business. Section 73A. But you can claim the losses. You can claim the losses only when you have filed the return of income before the due date under 139(1). So, losses can be claimed if return of income filed before due date under section 139(1). Further, the losses can be carried forward for indefinite period. So time limit for carry forward of losses indefinitely. Fine. Okay. Yes or no? Fine. So let's solve a question around this. Yes. Let's solve a question. And then we have last one more point on 35 AD after we solve the question. So just copy this question. Yes, copy the question and start solving. Okay, Viraj, let me just check and go back to the sum. Meantime, you can start copying. Yes, you're right, Viraj. Let students copy this and then I'll tell them regarding that also. Yes, students, have you copied? Let's start with the sum. So on 1st April 2023, Export House set up the warehouse in Telangana for storage of agricultural produce. Expenses incurred which are capitalized on 1/4/2023, purchase of land, construction cost, know-how, salary to staff. Expenditure incurred during the previous year, construction cost of warehouse, purchase of plant and machinery, old plant and machinery from domestic, import of second-hand plant and machinery from UK, purchase of new plant and machinery, 9 lakh, goodwill is 3.5 lakh. Following amounts are debited or credited to the P&L and net profit is 98 lakh 65. So I'll start with the net profit first. Is 98 lakh 65,000. Fine. Then what I will do is I will make the allowances and disallowances in respect of this particular net profit that I have. Fine. So net profit is 19 lakh 65. First is depreciation on building and on machinery. What will be the impact of that? Whether depreciation will be allowed, depreciation on building and on plant and machinery. Yes, students, past. So depreciation will not be allowed. Depreciation will not be allowed. Why? Because you are getting the cost of asset as the deduction. So you will not be eligible to claim, in fact, the depreciation. You cannot claim the depreciation because what you're getting as deduction is the cost of asset. Yes, Geeta, you are correct. So what we will do is we will add back the depreciation. Add item disallowable. Depreciation on building 3.5 lakh. Depreciation on machinery. Sorry, this is 3.4 lakh and this is 3.5 lakh. Cost of know-how of rupees 10 lakh was written off. Cost of know-how of rupees 10 lakh was written off. So again, you are getting the deduction of the capital expenditure which you have incurred. So now you will not get again the deduction of know-how. We will consider it as a part of 35 AD only. So I will add back 10 lakh. I will also add back donation to political party. Not allowable under section 37 2B. Fine. 10K. Commission income is 20.1 lakh and dividend is 50,000. So this will be reduced less income considered separately. Commission is how much? 20.15 lakh. Dividend is 50,000, right? So what I will do is I will consider these amounts in as separately, right? Under the income from other sources. So I will put it over here. Income from other sources. One second, let me just. commission, dividend income. Plus, I will also have deduction under chapter 6A, which is donation to political party. This is under section 80GG B. Right? How much was the donation? 10K. Next is expenditure in cash. Of course, this will also be disallowed under section 40A3. Brought forward business loss and brought forward specified business loss is 2 lakh. That we'll see later. Now, with regard to the deduction under 35 AD. So, deduction under section, first I will calculate my profits and then I will calculate my deduction under 35 AD. So what will be my deduction under 35 AD? Yes, students. So for deduction under 35 AD, the expenses which are capitalized, right? The expenses which are capitalized, I will consider that. So what are the expenses which are capitalized? Construction cost, know-how cost, and the salary. I will not consider land. So 8 lakh plus 10 lakh plus 78,000. So 18 lakh 78,000, right? Prior expense capitalized. Or you can write it like this: pre-commencement expenditure capitalized, except land. 18 lakh 78,000. 18.78 lakhs, right? Then what about the current year expenses? Current year expenses, I will have the construction cost of warehouse. I will take into consideration that. Now, first you will also check when you are starting the question whether this entity is eligible for the 35 AD deduction or not. Because it has some old plant and machinery. So what is the value of old plant and machinery? 2 lakh. What is the value of total plant and machinery? So my total plant and machinery is worth rupees 11 lakh. The 20% of that is 2.2 lakh. Now this old plant and machinery less than 20% of total plant and machinery. So therefore eligible for 35 AD deduction. Eligible for 35 AD deduction. So I will take this machinery cost. I will not take the goodwill. So what we will take here? The current year capital expenditure which we have. What is the current year? Construction cost and the plant and machinery. So write down current year capital expense, construction cost, plant and machinery. What is my construction cost? Construction cost is 60 lakh. And what is the value of my plant and machinery? Sorry, the total value of plant and machinery was 15 lakh and not 11 lakh. So this should have been 30%. 20% is 3 lakhs. So my total plant and machinery, I will take 15 lakhs over here. So my 35 AD deduction will be 18.78 lakh plus 60 lakh plus 15 lakh. 93.78 lakh. Right? And what is my PGBP coming before deduction? 98 lakh 65,000 plus 3. Yes, what is the amount coming to? 95.4. 1.62 is the PGBP that is coming in. Right? 1.62 is the PGBP that is coming in. Isn't it? Are you getting this answer? Yeah. Now we have the brought forward losses and the specified business loss. What about that? Mancha, pre-commencement know-how cost. Yes, it is to be considered. That's what we have taken also. Yes. Whether the specified business loss will be allowed over here. We have business loss, we have specified business loss. What will you do? Yes, students. Geeta, the business loss can be set off against the specified business income. The specified business loss cannot be set off against any other business. But the other business loss can be set off against the specified business income. Are you getting that stuff? So, remember one thing very carefully. Now, the business loss have a time limit of carry forward of 8 years. Specified business loss can be carried forward indefinitely. So what I will do is, I will first set off the business loss. Because specified business loss, any which ways, I can carry it forward for indefinite period. And therefore, I will first set off the business loss. So less business loss. Right? This can be set off against specified business income. In the exam, you will first start writing, the moment you will start the answer, the first note that you will give is that this business of export house or setting up the warehouse for storage of agricultural produce is an eligible business for section 35 AD deduction. This is the first point you will write in examination. Are we clear? Then you will like this business loss. This can be set off against a specified business income. Since business loss can be carried forward for 8 years and specified business loss can be carried forward indefinitely, we will first set off business loss. So what is my business loss? It is 1 lakh. and still I have 0.62 lakhs, right? Still I have 0.62 lakh. So that also I can set it off. Are we getting that? So that also I can set it off. So what you will do in this case? You will carry forward the balance brought forward business loss. Are we clear? So just write down 0.62. I will set off less brought forward business loss 0.62. So this will be nil. So the balance loss can be carried forward, which is 1.38. Yes, students. Is it clear? Yes or no? Yes or no? Fine. Okay. Then what is your total income then coming to? Calculate your total income. Yes, calculate your total income. Yes, fast, give me the answer. Yes, faster. So this is 20.15 plus 50,000 plus minus 10,000 of deduction. So 20.55. Okay. So this is my total income. Yes, students. In the earlier question also I had done some small error. So you can just make the rectification. I made it. So I had considered here instead of 80K, I had considered 80 lakh. So these are the revised amounts. Maybe you can just write down these revised amounts. I made some small error over there. Yeah, just make these changes. There was some calculation mistake which I have rectified. Okay. So we are proceeding now further. Now there's one important point under 35AD which I would like to discuss with you before we, just close 35AD. If any, let's say for example, the asset is used for the specified business. There's a condition that the asset has to be used for the specified business for a period of 8 years. So section 35 provides that any asset for which you have claimed the deduction that shall be used for a specified business for a period of 8 years. Now, if any asset on which deduction has been claimed under 35AD is transferred, then the amount which is received will be chargeable to tax under 28(7). Then it will be chargeable to tax under 28(7). So you can write down over here. You can write here one more condition. Asset purchased for specified business on which deduction is claimed under section 35AD to be used for 8 years from the previous year in which asset is purchased. Fine. Now there are two things over here. If the asset is sold or demolished or discarded before the period of 8 years, so asset sold, demolished or discarded before the 8 years, then amount received will be PGBP under section 28(7). This we had not discussed in 28 because I wanted to discuss it over here. If the asset is used for any other business, in case the asset is not demolished or sold, but it is used for any other business other than the specified business, other than the specified business, then in that particular case, what you will do, which is less than or before the 8 years, then the total deduction claimed earlier as reduced by the depreciation which will be notionally allowed on that asset had it been used for the business, that will be deemed to be the income under PGBP. So there will be two steps. First, deemed income. What will be my deemed income? The deemed income will be deduction claimed under section 35AD minus notional depreciation under section 32(1)(2). Second would be, what will be the actual cost of asset? What will be the actual cost of asset for the other business? Like the similar way, we had it in scientific research. If the asset is used for scientific research, it is transferred to other business. Actual cost was nil. But here it's not the case. So here the actual cost for depreciation will be, actual cost for the depreciation shall be actual cost of asset minus the notional depreciation. Minus the notional depreciation. So this is how you will calculate. So let's take an example where, let's say for example, I had claimed the deduction for the, let's say, building. Let's say deduction under section 35 AD for building rupees 100 lakhs. Right? However, now I transfer out of this one building, let's say, to non-specified business into two buildings. One building transferred to non-specified business. Right? So what we will do over here? So here my deemed income will be 50 lakh minus the depreciation 5 lakh, 45 lakh will be my deemed income. And for the depreciation, actual cost to non-specified business for depreciation again will be 50 lakh minus 5 lakh equal to 45 lakh. Are we clear? Yes or no, students? Yes? Fine. Yes or no? Okay. Now last one deduction that we are going to deal with is very, very important. Deduction for telecom and spectrum license under section 33, sorry, not under section 33, sorry. This will be the deduction for the telecom license and the spectrum license, which is again a deduction for a certain sector. This is given under section 35 AB. And 35 ABB. For spectrum, it is under 35 ABB, and for the for the spectrum, it is under 35 AB, and for the telecom, it is under 35 ABB. So this is ABA, ABB, and ABA. Okay. Now this is for the specific for the spectrum and telecommunication license. Now, understand how do we get the deduction over here. There's a way to calculate the deduction. So, expenditure which is incurred for obtaining the right to use. Expenditure which is incurred for obtaining the right to use the spectrum is under 35 ABA, and the expenditure which is incurred for license to operate telecom services is under 35ABB. So just write down expenditure incurred, expenditure which is incurred for obtaining right to use spectrum This is under 35ABA or expenditure incurred for expenditure incurred for the license to operate the telecom services. This is under 35ABA. Okay. So, what is allowed as the deduction over here? Now, as I said, any capital expenditure incurred for acquiring the right to use the spectrum, right? For acquiring the right to use the spectrum either before the commencement or after the commencement of the business, and for which the payment has been actually made, that capital expenditure is allowed. So the capital expenditure, so see, if you look at it, these 33AB, 35AD, 35, section 35ABB, all of these sections are allowing you the specific capital expenditure deduction. Otherwise, capital expenditure is not allowed as deduction. These sections are enabling you to claim the capital expenditure to incentivize these industries, isn't it? So capital expenditure to obtain the right to spectrum, or for that matter, the telecom license will be allowed. So write down expenditure, capital expenditure, sorry, not the expenditure, the capital expenditure incurred for acquiring the right to use spectrum or in the case of the telecom for acquiring any right to operate telecom services pre-commencement, right, or post commencement will be allowed as deduction allowed on the payment basis. So this particular section does not allow you the deduction in the year in which you incur the expense. This allows you the deduction in the year in which you make the payment. Okay. So this is the deduction which is allowed on the payment basis. Are we clear? Now, how the deduction is to be allowed, that we will see. That we will see separately. Okay. But first of all, you need to understand that the deduction of the capital expenditure is allowed. Are we getting that? So just write down deduction allowed on the payment basis. Now, there is a latest Supreme Court ruling in Bharti Hexa. This is not there in your module, but this is a latest Supreme Court ruling which was delivered 3 days back. And this is applicable for your examination. So this will form part of the material which will be supplementary material issued later. But we are discussing at the moment. This is the latest Supreme Court ruling. Bharti Hexa. There, the question before the Supreme Court was that where the amount of license fee which was paid, the license fee which was paid in two components. The one component was the lump sum license fee which was paid, which was of course as a right to obtain the telecom license to operate the telecom services, which was a capital expenditure. The second component was that the second amount of the variable component, which is based on the percentage of the profits you will derive. The second component was a variable component where the amount which you derive as profit, out of that you will have to pay certain amount to the government as a license fee. So, variable license fees paid in installments, whether this is a revenue or a capital expenditure. The assessee claimed this as a revenue expenditure, claiming because we are paying it in installments, this is a revenue expenditure. The Supreme Court said, look, whether it is paid in lump sum or whether it is paid in installments, that will not be a decisive factor to determine whether it is a capital expense or whether it is a revenue expense. What you are paying is a license fee. If you would have not paid this license fee, you would have not got the right to use the telecom license. You would have not received the telecom license. So this is in fact one of the essential ingredients to obtain the telecom license. So therefore, this will be not a revenue expenditure. This will not be a revenue expenditure. This is a capital expenditure. The Supreme Court held, and this will be allowed as deduction as per 35A(b). So it held that this is the expenditure towards the establishing, operating and maintaining telecom services. Merely making the payment of license fee in installment does not convert into a revenue payment. A lump sum payment can be a revenue expenditure also. But if the installments are paid for acquiring a capital asset, that is in fact a capital expenditure. So you have to look at the source of the payment, the original source, the original obligation. So it's held that the consideration was in fact paid to establish, maintain and operate telecom services. And you cannot then bifurcate into two components. So this was towards the right to maintain and operate the telecom services. And therefore, this is the, again, going to the original source, a capital expenditure. So variable license fee paid in installment is capital expenditure since it was paid, since it was towards acquiring telecom license. The license fee cannot be bifurcated into obtaining license and fees for maintaining telecom operations. This was composite payment. Okay. So if it is a capital expenditure, this will be governed as per 35A and AB. Okay. Now deduction, as I said, is allowed on the payment basis. But how will you allow the deduction? The deduction is allowed on the pro rata basis. Deduction on pro rata basis. Deduction on the pro rata basis. Now, how do you calculate the deduction on the pro rata basis? So, it is allowed over the number of years. It is allowed on the number of years. Now, if the license fee is paid before the commencement of the business, over specified previous year. If license fee is paid prior to commencement of business, then in that particular case, what will be the period for which it will be allowed? So this will be allowed for the from the previous year in which business is commenced till the period the license is expiring. For the previous year in which business is commenced till previous year in which license expires. If license fee is paid after the commencement of business, if the license fee is paid after the commencement of the business, then from the previous year in which the license fee is paid till the previous year in which license expires. Fine. Now, what if the license is transferred? What if the license is transferred before the expiry? Now, if let's say, for example, the sale proceeds are greater than the unamortized amount. Let's say sale proceeds greater than unamortized amount. Then in that particular case, the whole or part of the license is transferred. Whether the whole or part of the license is transferred, How will you calculate? Here, it will be deemed to be the profits in the year of transfer. Deemed to be the profits in the year of transfer. Deemed to be profits in the year of transfer. In case I have transferred the amount, in case I have transferred the license before the license expires, right? In that particular case, what will happen is, if let's say my sale consideration is exceeding the unamortized amount, then it will be taxable, deemed to be the income of the previous year in which there is transfer. Now, what will be charged over here? Lower of sale consideration minus the unamortized expenditure or expenditure allowed till date. Expenditure allowed till date. So lower of this will be allowed, will be considered as my income. Fine. If let's say, for example, my sale consideration is less than unamortized amount. In this case, if whole license is transferred and if part license is transferred. If the whole license is transferred, right? If the whole license is transferred, then in that particular case, what will we do? So where a whole license is transferred, the entire license is transferred, then the amount of deduction will be expenditure remaining unamortized expenditure minus the sale consideration. This will be allowed as deduction. This will be allowed as deduction. So see, this is similar like your terminal depreciation and the balancing charge, isn't it? Or the transfer of the scientific research asset which you have purchased. If let's say, for example, the part license is transferred. If the part license is transferred where the sale proceeds are less than, where the sale proceeds are less than the unamortized amount, then what you will do is the remaining unamortized amount will be deductible over the period of license. So, write down amount of deduction is unamortized amount minus sale consideration or balance period will be allowed to you as a deduction. In case there is amalgamation, in case of amalgamation 35 ABA or ABB allowed to amalgamated company. Okay, and same to the resulting company or resulting company. ठीक है, fine. Now let's take an example to understand this particular license is transferred. Let's say, for example, where X Limited acquired a telecom license at a cost of 50 lakh. Cost of the license was 50 lakh on, let's say, 1/4/2021 for 10 years. Fine. Now let's say it is transferred, first scenario, for rupees 32 lakh. Transferred for 32 lakh. Next is transferred for, let's say, 43 lakhs. And third one is, let's say, transferred for 52 lakhs. Now we'll consider both the scenarios. Whole of the license is transferred, part of the license is transferred. Part license transfer. Now when the whole of the license is transferred, let's say if it is transferred for 32 lakh, 32 lakh is less than rupees 50 lakh, right? Now this is, let's say, transferred in previous year 23-24. So till that time, how many years deduction I would have claimed? 21-22, 22-23. 2 years deduction I have already claimed, right? So what will be my deduction each year? Deduction for each year is equal to 50 divided by 10. This is going to be 5. So what is my unamortized amount? What is my unamortized amount? My unamortized amount is 50 lakh minus 5 into 2 years. 40 lakh, right? Now 32 lakh is less than 40 lakh, right? So the expenditure which is remaining unallowed will be allowed as the deduction. So 32 minus 40 or 40 minus 32, 8 lakh will be allowed as the deduction. So this is what the table says, right? Unamortized expenditure minus the sale consideration will be allowed as deduction. If it is 43 lakh, this is more than, of course, the transfer amount. What is the transfer amount? It is transferred for 43 lakhs. So it is still 43 lakh is more than the unamortized amount, which is 43 lakh. So it will be deemed to be the income. The income will be what? 43 minus 40, which is 43 minus 40, which is 3 lakh. Or unamortized amount is 40 lakh, right? Oh, sorry, the expenses allowed till date. Expense allowed till date is 10 lakh. So lesser of this is 3 lakh. This will be income. This 3 lakh will be income. If it is transferred for 52 lakhs, then also you will first consider 52 minus 40, 12 lakh. Expenditure allowed till date. So 10 lakh will be my deemed income. 10 lakh will be my deemed income. Also, there will be, in this case, like, balancing charge, there will be short-term capital gain of 52 minus 40 minus 10 of 2 lakhs. Fine. Okay. Now, if the part license is transferred, keeping the amount same, Now in the first case, 32 lakh is there. This is lesser than the 40 lakhs, right? This is lesser than the 40 lakh. So what I will do is this 8 lakh which is there, which is 40 minus 32. This is to be amortized for the balance years, which is 8 years. So 1 lakh each year, right? In case it is for more, then the answer will remain the same. Because if the sale consideration is higher, whether it is part or full, it will not make any difference. Fine. Are you clear with this point? It's very similar to the terminal depreciation, scientific expenditure, like that. So see, in case of the scientific also, we did a similar thing, if you remember. See, I told you, capital expenditure, capital asset used for scientific research, which is sold. Sale consideration plus deduction claimed under 3514 is greater than the total capital expenditure. Then you will have the taxability under 41(3), which is deemed income, which will be deemed income, right? So under 41(3), lower of amount of sale proceeds or deduction allowed earlier. Deduction claimed earlier or excess amount. Excess amount is what? The sale consideration minus the deduction claimed. Fine. It was same. And there will be capital gain, which will be for the balance portion. It's the same thing under 35AB also. Under 35 ABA, ABB, it's the same thing exactly. Yes or no, students? Are we clear? Yes? Fine. Yes or no? Okay. So we are done with the specified deductions. Any question, any doubt you have? Yes? Yes, any question? Yes, under the scientific research also, let's say for example, you had claimed the capital expenditure of 3 lakh. Now, if the asset is, let's say, sold for 4 lakhs, then 3 lakhs or the sale consideration 4 lakh minus 3 lakh, right? Lower of the sale proceeds and the deduction of 3 lakh would be charged to 41(3). Yes, here it should not be, sorry, here it should be sale consideration, not the excess amount. Sorry, this is your mistake. Let's say if sale consideration is there, right? It is exceeding the total capex. This is just rectify in scientific research. So let's say 4 lakh is greater than 3 lakh, then 4 lakh or lower of 3 lakh is charged under 41(3). So here there will not be any capital gain. Yes. Fine. So if the capital expenditure is 3 lakh and asset is sold for 4 lakh, then out of 4 and 3 lakh, the 3 lakh would be charged under 41(3). Fine. Okay. In the previous year in which asset is sold. Okay. Yes or no? So in the scientific research, there is little difference, but it is more like the balancing charge and terminal depreciation. Okay, yes. Now, last one deduction that is pending under 35 is that is in respect of the VRS, Voluntary Retirement Scheme. For that, if the company incurs any expenditure, that is also allowed as the deduction to the company on the pro rata basis. That is also allowed to the company on the pro rata basis. Now, what is the deduction? Just like we had 35D, We have also something called as 35DD and 35DDA. So the expenditure on VRS section 35DDA, sorry. What is the expenditure which is allowed? 1/5 over 5 years. Okay. Now, in case there is, what are the conditions? The conditions are that there should be the VRS expenditure which has been incurred by the company. In case there is transfer of business, it will be available to the successor company as well. It will be available to the successor company as well. Successor company on reorganization. Next one is expenditure on amalgamation or demerger. Under section 35DD. Again, here it is 1/5 over 5 years. Now, this is not allowed to the other company because this is on amalgamation and demerger. So, obviously, this is to be allowed to the company which has incurred that expenditure. Fine. So, we have completed all the deductions which are there under PGBP. Now, what is else which is remaining is section 41, which is the deemed income. So, under 41 also we have covered many of the provisions under section 41. 41 for the scientific research expense where there is deemed income on the asset transfer. Balancing charge for the depreciation to power generating unit, that also we have covered, isn't it? So on various places we have covered section 41 already. So what else is remaining? Just write down section 41. Deemed income. Now section 41 which is there is a deemed income provision which is in case there is remission or cessation of liability, of trading liability. So where there is remission or cessation of trading liability. What is the meaning of remission or cessation of the trading liability? So let's say, for example, where you claim a deduction for any trading expenditure. Now, later on, that expenditure has been, let's say, waived off. So there is remission or cessation. So the value of that benefit will be considered as income under 41(1). So what is the condition over here? Expenditure should have been claimed as trading expense. So expenditure should have been claimed as, or there should have been deduction or allowance in respect of expense or trading liability. You can write it like this instead. Deduction should have been claimed in respect of loss expenditure of trading liability. And now, what is the scenario? The benefit is obtained by the cessation or remission of the liability. Benefit is obtained by remission or cessation of the liability. Then in that particular case, the benefit that you are getting will be deemed to be the income. Deemed to be the income. Deemed to be the income. Are we clear? So it is possible that the expenditure may have been claimed by, let's say, a demerged company. Now there is a new resulting company which has carried forward that business, and the waiver of liability has happened in the hands of the resulting company. Or let's say where there has been amalgamation, the expenditure was claimed by the amalgamating company and the successor is amalgamated company, the waiver is happening in the case of that company. So the successor will be taxed in the hands, in respect of the benefit received. So you can write down where the expenditure or liability, or you can write where the deduction was claimed by predecessor and benefit of waiver or remission, not waiver, remission, benefit of remission or cessation is received by successor, not company, benefit taxed in hands of successor. Benefit will be taxed in the hands of successor. Okay? Yes. So, understand one thing. Let's say there is a waiver of loan. Now, that will be taxable under 28 also, under 28 4 also, right? Where there is benefit or perquisite in cash also, which is now getting covered. But there, which kind of waiver will be taxed? The waiver of any loan. Here, the waiver of trading liability may be taxed in the 41. Are we getting that? Under 28.4, 28.4 is a general charge, which is in respect of benefit or perquisite in cash. This is benefit which is remission or cessation of a trading liability. So that will be specifically covered under section 41. So remember that particular distinction. Are we clear? Last section is 43D. Last one section before we close off. Or you can write it over here. Waiver of trading loan 41.1. Other loan 28.4. Okay. Last one section 43D. Now section 43D, which is there, is specifically for the banks. Section 43D, which is there, is specifically for the banks. Now in respect of the banks, you know what happens is that they may have interest. They may have interest, right? They may have interest on the non-performing asset. So this is for the banks and NBFCs. Now, in case of the non-performing asset, the interest on doubtful debts will be charged as income of the previous year of the previous year in which interest is actually received. Because otherwise, what happens if we follow the accrual concept for the bank? Now, in case of the doubtful assets or the bad debts, they may not receive the interest, the assets which are turned into NPA. Now, if we charge that interest on accrual, they will have to pay tax even though they are not receiving the principal amount also, right? Forget the interest. So for the banks and NBFC, 43D creates a specific provision which says that interest on the doubtful assets will be considered as the income of the previous year in which the interest is actually received by them. Clear? So we'll stop here for today because now what is remaining is, yes, presumptive income Mansha is remaining, which we are going to do in the next class. Presumptive income 44AA, 44AB. In the next coming class, we are going to deal with that. Also, I would want you, before we close the session, please take the picture of this sum, which we will be starting with the next class. I want you to solve this sum in the next class. So you can just take the picture of this particular question so that we start solving it in the next class. And we will then start with the capital gain. So the first half of the class, we are going to cover 44AA, 44AB and presumptive tax. Also, there is one ICDS which is pending on construction contract, which is what we have to do. And if the time permits, we will do this sum. At least we'll discuss this sum very quickly. So you can take this and then we can just close the session. Okay? Yes, Vanshika, in the next class, we'll finish the PGBP. Yes, have you copied the sum or taken this picture? And then I can just close the session. So just take the picture of this. Yes, students, is it done? Because once we close the session, you will not be able to see this. Okay, so I'm just closing off the session then. Okay, yes. Okay, thank you so much. We can close the session. Yes.